Hey there, and welcome back to The Deep Dive. This is your fast track to understanding what truly matters from the latest earnings calls.
That's right.
Today, we're doing a deep dive into Huron Consulting Group's Q2 2025. And believe me, this quarter wasn't just about numbers. It was about some seriously savvy strategic moves and a clear, confident vision for the future.
Yeah, the market definitely paid attention.
It did.
Our mission today is, well, to cut through the noise, giving you the core insights into Huron's performance, where they're heading strategically, and what management is really signaling for the rest of the year and beyond. This isn't just a report. It's, a compelling story of a company not just navigating, but actively thriving amidst some pretty complex market dynamics.
Absolutely. So let's jump right into the highlights then. Huron Consulting Group delivered a genuinely strong second quarter.
It really did.
They didn't just meet expectations, they decisively beat them. Their adjusted earnings per share came in at $1.89, comfortably surpassing the $1.79 consensus by, a solid 5.6%? This tells us management is not only executing effectively, but also delivering more profit than maybe even the most optimistic analysts predicted.
And on the revenue front, they've truly broken new ground. Their revenue before reimbursable expenses, or RBR as they call it,
RBR.
hit a record $411.8 million. That's an impressive 8% jump year over year, and marking the first time they've crossed that $400 million RBR threshold.
That's a big milestone.
It is. That kind of top-line growth signals robust underlying demand and a powerful sales engine. Now, quick note, their GAAP EPS was $1.09.
Okay.
Which included an $8.2 million non-cash impairment charge. But we'll unpack why that adjusted number, the $1.89, is so significant in a moment.
Right. Yeah, a really important distinction we'll definitely explore. But the big takeaway here is confidence. Management is practically shouting confidence from the rooftops, raising their full year 2025 guidance across the board. This isn't just a tweak. It's a strong belief in their sales pipeline and their ability to execute. They've bumped their full-year RBR guidance up to between $1.64 billion and $1.68 billion.
That's a nice lift.
And adjusted EPS guidance moved up to a healthy $7.30 to $7.70 range.
And crucially, their adjusted EBITDA margin guidance was maintained, right, at that healthy 14.0% to 14.5% of RBR.
Yeah, holding steady there.
This updated outlook was clearly music to investors' ears. The market responded quite positively.
It did. Shares gained approximately 5-6% by the next regular close after the report.
That's a clear vote of confidence, validating management's upbeat assessment.
That's a great start to our deep dive. So let's dig a little deeper into those numbers, starting with that difference between GAAP and adjusted EPS you mentioned earlier.
Yeah.
When we see a GAAP EPS of $1.99, which includes that $8.2 million non-cash impairment charge, and then an adjusted EPS of $1.89, it can be, a bit confusing. How should we as listeners think about why management emphasizes that adjusted number as the real indicator of their operational health?
That's a critical point, yeah. Management really wants us to focus on that $1.89 adjusted EPS because it strips out one-time non-cash events like that $8.2 million impairment charge.
Yeah.
This one came from a convertible debt investment.
Ah, okay.
Think of it this way. The adjusted figure is a much truer representation of their day-to-day operational momentum and their core cash earning power.
Right.
That impairment charge didn't actually affect their cash flow for the quarter, so the adjusted number, which showed a strong 12.5% increase over Q2 2024's adjusted EPS. That's the cleaner look at how the business is truly performing.
Makes sense.
Also, their adjusted EBITDA, which is, another key measure of core profitability, was $60.6 million. That's 15.1% of RBR, up nicely from the prior year's $55.7 million or 15% of RBR.
So it's about seeing the forest for the trees, focusing on the sustainable operational performance.
Exactly.
And that operational strength is further highlighted by their organic RBR growth, right? 4.2% year over year.
That's right. That's real homegrown growth driven by existing operations, which is always a good sign. And it spanned all three of their operating segments.
Okay. Moving beyond the income statement then, what does the balance sheet and cash flow picture tell us about Huron's overall financial health? Is it just as strong?
It is, yeah. The balance sheet looks robust, which is, key for a consulting firm that needs flexibility for growth and maybe acquisitions.
Sure.
They generated $80 million in cash flow from operations, which led to a strong free cash flow of $73.7 million.
Nice.
And a really positive operational improvement was the decrease in days sales outstanding, or DSO.
Ah, collections.
Exactly.
Yeah.
It dropped to 78 days from 81 days in Q2 2024. Now, that might sound like a tiny tweak, 3 days,
Doesn't sound like much.
but for a company of Huron's size, it's like finding a significant chunk of cash under the couch cushions. It's a direct boost to their liquidity,
Right. It means they're getting paid faster by client.
which in this economy, is gold.
Definitely. That's a direct impact on their ability to fund operations and future growth. What about their debt situation? How are they managing their capital structure?
Well, their total debt stood at $657.8 million at the end of June, with net debt, so debt minus cash, at $596.8 million.
Okay.
Their leverage ratio, a key metric banks look at, was 2.5 times adjusted EBITDA. And management expects to bring that down further to around 2 times by year-end.
So deleveraging is a focus.
It seems to be. But here's where they made a smart, proactive move. In July, just after the quarter ended, they amended their credit facility.
Oh, yeah? What do they do?
They extended its maturity all the way out to 2030 and increased their borrowing capacity significantly, up to $1.1 billion. And they did it on very favorable terms.
Interesting. So locking in capacity in good terms for the long haul.
Precisely. This isn't just about managing existing debt. It provides them with substantial dry powder and flexibility for future strategic moves, whether that's more acquisitions or other capital allocation priorities.
That's a strong position to be in, especially given the, dynamic market. Let's shift gears then and look at what's really driving their business segment by segment. Huron operates across healthcare, education, and commercial.
Right.
Starting with healthcare, which is almost half of their RBR, right? How did it perform, and what's fueling demand there?
Yeah. Healthcare is the biggest piece, 49% of total RBR. It saw its revenue grow by 4% in the quarter.
Okay.
Or actually an even more impressive 6% if we exclude that student education business they divested earlier.
Ah, okay. So underlying growth is even stronger.
Correct. The demand environment here is incredibly strong, especially for things like performance improvement, financial advisory, strategy, and innovation work, and also managed services.
And a major piece of that demand story seems to be related to this legislation, the One Big Beautiful Bill Act. Can you elaborate on its impact and how it's shaping client needs in healthcare?
Absolutely. Yeah, Huron's management spent significant time discussing what they referred to as the One Big Beautiful Bill Act. Now, this legislation, it recently passed, and it's bringing substantial clarity, maybe unwelcome clarity for some, on anticipated reductions in federal healthcare spending.
Okay. What kind of reductions are we talking about?
They highlighted projections of over $1 trillion in Medicaid cuts over the next decade, and potentially, up to 10 million more uninsured people as a result.
Wow, those are huge numbers.
Huge. Now, regardless of where you stand on the policy itself, for Huron, this creates an undeniable and frankly urgent demand for their advisory services.
Right, because hospitals are facing what?
Immense margin pressure, rising costs, uncertainty about reimbursement. They're turning to Huron for solutions to navigate these substantial financial and operational challenges.
So it's a challenging environment for the providers, for the hospitals, but it's actually creating a pretty clear opportunity, a tailwind almost for Huron.
That's exactly how management framed it. But you mentioned a nuance regarding digital offerings within healthcare, though. Management noted a temporary pause in larger standalone digital transformation engagements. What's behind that?
Yeah, what's that about?
Yes, that's correct. While overall digital demand remains solid, clients are essentially triaging their needs right now. Meaning instead of maybe undertaking massive multi-year digital infrastructure projects right now, they're prioritizing immediate financial stability and performance improvement. Stopping the bleeding first.
Makes sense. Fix the urgent problems before the big overhaul.
Exactly. However, management is confident this is just a temporary pause. These foundational digital transformations are still absolutely necessary for hospitals long term.
Right. They can't put them off forever.
No. They'll eventually need to be addressed once clients achieve that financial stability. And importantly, Huron's raised guidance for the year isn't banking on a quick acceleration of these larger digital deals.
Good to know. They're not dependent on that snapping back immediately.
Correct. They also bolstered their healthcare capabilities recently, by the way, with the acquisition of Eclipse Insights back in June. That strengthens their mid-revenue cycle expertise.
Okay, another strategic tuck-in. Fascinating clients are definitely in problem-solving mode. Let's move to the education segment. That's what, about 32% of RBR? How did it perform?
The education segment also had a strong quarter. It achieved record RBR and record sales conversion, growing RBR by 5%.
Nice. What's driving demand there?
Well, there's strong demand for their strategy and operations offerings and also for their specialized research software products. Universities and research institutes, they're grappling with significant uncertainty too.
From what?
From evolving regulatory environments, potential lower indirect cost reimbursement rates for research grants, maybe reduced federal support overall, and anticipated enrollment declines in some areas.
So a similar story to healthcare, in some ways major macro pressures driving demand for Huron's expertise.
Exactly. Even though that one big beautiful bill act apparently offered some clarity on, say, endowment earnings taxation, the broader landscape for education clients remains really complex.
So they need help with
Cost reduction, optimizing operations, strengthening their finances, improving fundraising strategies, all the core things Huron does. And acquisitions like Advancem Resources and Halpin, which closed earlier in the year, also contributed to this segment's strong results.
Okay. Finally, the commercial segment, making up the remaining 19% of RBR. This one saw some pretty explosive growth, didn't it?
It truly did. The commercial segment achieved record RBR as well, growing a remarkable 28%.
28%. Wow.
Yeah. Now, some of that was inorganic. It was 23% if you exclude the Axia acquisition they did.
Still very strong organic growth, though.
Absolutely. So the growth was fueled by that Axia acquisition itself and also very strong demand for digital offerings in the commercial space.
What are clients looking for there?
Global clients, facing a volatile macroeconomic environment, they're turning to Huron to help advance their competitive positions, drive operational efficiency, and leverage data more effectively. Basically, navigate the uncertainty.
And they made another significant acquisition to boost this segment just recently, didn't they, after the quarter closed?
They did, yeah. In early July, Huron acquired Treliant. Treliant is a financial services advisory partner.
Okay, specializing in
Crucial areas for banks and financial institutions. Risk management, compliance, operations, financial crimes, fraud. Really important stuff right now.
Definitely.
Treliant's results will start contributing from Q3 onwards, further enhancing Huron's ability to tackle complex challenges for their financial services clients.
It's really clear these strategic acquisitions are a core part of Huron's growth story. Let's talk a bit more about their overall impact and the strategic outlook. How are these fitting together?
Well, these targeted tuck-in acquisitions, including the latest ones, Eclipse Insights and Treliant, along with earlier ones like Axia and Advancem Resources, they're all about strategically enhancing their capabilities and broadening their service offerings in key areas.
Right. And what's the expected financial impact from these latest acquisitions, Eclipse and Treliant, in the short term and then looking further out?
So specifically, Eclipse and Treliant together are expected to add approximately $20 million in RBR just in the second half of this year, so H2 2025.
Okay. Decent contribution pretty quickly.
Yeah. But for the remainder of 2025, they're projected to have basically a neutral impact on adjusted EPS. That's due to integration expenses.
Yeah.
The costs of bringing them into the fold.
Standard integration drag initially.
Exactly. Think of it as a short-term investment. But here's the key part. Management expects them to become adjusted EPS accretive in 2026.
Meaning they'll start boosting the bottom line next year.
Correct. They'll actively start contributing to earnings per share growth then. And Huron is committed to this programmatic M&A strategy, aiming for about 4% inorganic growth annually through these kinds of deals.
So a disciplined, repeatable approach to growth through acquisition. And how does this fit into their broader capital deployment strategy? Is it all M&A?
No, their strategy is quite balanced, actually. They're combining these strategic acquisitions with returning capital to shareholders.
Through buybacks?
Yep. In Q2, Huron repurchased 430,000 shares for about $61 million. That brings their year-to-date total buyback to $133.9 million.
So quite active on the repurchase front, too.
Yeah, it demonstrates a commitment to both investing in future growth through M&A and rewarding existing shareholders through buybacks.
With all these moving pieces, strong organic growth, acquisitions, navigating macro trends management, sounds incredibly confident in their outlook. What gives them that conviction? What did they point to?
They cited several factors. First, robust sales conversions in the first half of the year, meaning they're winning the deals they're pitching. Second, a healthy pipeline of emerging opportunities.
Okay.
And third, increased clarity from the regulatory environment, particularly with that one big, beautiful bill act, which, again, is driving demand. They also noted their utilization rates.
Ah, yes. How busy are the consultants? What were those numbers?
Consulting utilization was at 77%, and digital was at 78%.
Those utilization rates sound pretty high. What does that imply for their business? Are they stretched too thin?
Well, management indicated these rates are near the top of what they consider their sustainable range,
Okay.
which is actually a positive sign in this context. It tells us they are very busy, yes, but also that they are aggressively hiring in these high-demand areas to build capacity and support continued growth.
So investing in people to meet the demand they see coming.
Exactly. It shows they're proactively managing capacity. For investors looking ahead, the key catalysts to watch will be the Q3 results that'll give us the first full look at Treliant and Eclipse's contributions,
Right?
along with ongoing integration updates and just getting more color on client budget cycles for next year.
Okay, so let's bring all of this together for you, our listener. Why should Huron's Q2 performance matter to you? Whether you're an investor, an industry observer, or maybe just curious about the economy, what's the big picture here?
Well, I think Huron's Q2 performance is really a masterclass in resilience and strategic execution in what is undeniably a truly complex market. The raised guidance, that record RBR, the positive market reaction, these aren't just numbers. They validate management's upbeat outlook and show a company that's not just surviving, but actually finding ways to thrive in a dynamic, disruptive environment.
And how is the company adapting to these massive macro trends, especially with things like the One Big Beautiful Bill Act reshaping entire industries?
Yeah, that Bill Act certainly presents significant challenges for both healthcare and education clients, no doubt about it. But here's the critical insight, I think. It simultaneously creates substantial demand for Huron's specific advisory services.
Right. Their expertise is needed because of the disruption.
Precisely. They are uniquely positioned to help clients navigate financial strain, operational disruption, and the pressing need for performance improvement, financial advisory, and strategy.
Yeah.
This challenge for others is a clear opportunity for Huron.
So their diversified expertise across these key challenged sectors is truly a competitive advantage right now.
I think so, yeah. The company's diversified service offerings and that deep industry expertise across healthcare, education, and commercial sectors position it incredibly well to address evolving client needs in this environment. And despite that one-time non-cash impairment affecting the GAAP EPS number,
Which we discussed.
the focus on adjusted metrics and that robust free cash flow really underscores strong operational health. And as we discussed, their strategic acquisitions are absolutely key to future growth, with that adjusted EPS accretion expected from 2026 onwards.
Okay, great summary. Now let's wrap this up with something a little more speculative. Purely forethought.
The fun part.
Exactly. The market has already factored in some of Huron's strength, obviously, but if you're looking for an edge, something a bit more outside the box, let's explore a couple of ideas from the more, let's say, aggressive end of the spectrum, and based purely on the insights presented in this call. Remember, everyone, this is not financial advice.
Indeed. Purely for informational purposes and, to spark some creative thinking about potential scenarios. Always do your own research.
Absolutely. Okay, our first idea, we're calling it the healthcare digital rebound play. So what's the thinking here?
Well, management explicitly called that slowdown in large healthcare digital transformation projects a temporary pause. And let's be real, hospitals must modernize their infrastructure eventually. Once the immediate financial pressures stabilize, it's not really an optional upgrade anymore, is it?
Probably not. So the conceptual play here is what?
Is maybe to take a longer-term bullish view on Huron, perhaps looking for entry points if the market gives you one, betting that this pause is indeed just that, a pause, not a cancellation.
Okay, and the rationale, why might that work?
The rationale for this kind of strategy is compelling, I think. It offers ample time for that temporary pause to resolve itself. It gives time for the integration expenses from Treliant and Eclipse to clear out of the P&L. And for those acquisitions to become EPS accretive in 2026, like management expects. So as digital projects inevitably resume and start contributing more significantly to earnings, the stock could see some significant upside.
It's basically a bet on the fundamental necessity of these digital transformations and Huron's existing relationships making them a natural choice when those budgets finally unlock.
Exactly. It's a timing bet, but based on a fundamental need.
Okay, interesting. Our second idea, the consulting consolidation alpha strategy. What's the thesis behind this one?
This one focuses on the broader industry. Huron highlighted that their clients face significant market disruption and are actively seeking partners with deep industry expertise, breadth of capabilities, and a proven track record.
Which sounds like Huron describing itself.
Pretty much. And remember, Huron is actively executing that programmatic M&A strategy to expand its capabilities, and it has that newly strengthened $1.1 billion credit facility.
Right, the dry powder.
Exactly. This suggests they are incredibly well positioned to gain market share and perhaps even acquire weaker players in a consolidating and uncertain consulting environment.
So the play isn't just about Huron, but Huron versus others.
Correct. For this play, it's about relative strength. You might consider a conceptual long Huron position while simultaneously considering that smaller, less diversified, or maybe more financially constrained consulting firms could really struggle in this environment. Maybe you look at shorting a basket of those types of firms conceptually.
A pair trade, essentially.
Yeah, conceptually. It's a bet on Huron's ability to not just thrive, but to actually expand its footprint and potentially scoop up some of these smaller, less agile players, leveraging its scale, its margins, its M&A capability to outpace competitors.
Playing the long game on industry consolidation with Huron as a likely winner.
That's the idea behind it, yeah.
Both are aggressive, definitely food for thought, but entirely plausible scenarios based on the insights from this earnings call. So to recap this deep dive for everyone, Huron Consulting Group delivered a standout Q2 2025, marked by record RBR, a solid adjusted EPS beat, and that optimistic raise to its full-year guidance.
Yep. And strategic acquisitions are clearly enhancing core capabilities, and the company seems to be very deftly navigating a dynamic regulatory and macroeconomic landscape.
The positive market reaction really underscores investor confidence, setting the stage for close monitoring of Q3 results, especially those acquisition contributions and ongoing integration successes.
Absolutely. Huron's ability to consistently execute and adapt to client needs, particularly in these disruptive environments, will be key to its continued trajectory, I think.
Couldn't agree more. Now remember, everyone, this deep dive is for informational purposes only and is definitely not financial advice. Always conduct your own thorough due diligence before making any investment decisions.
Please do.
And one final thought for you to ponder. Given how Huron is navigating disruption in healthcare and education, what similar seismic shifts might be happening or are about to happen in your own industry, and how might companies, maybe even your company, best position themselves for that next wave of change?
Good question to think about.
We encourage you to share your thoughts and analyses with us if you like. Thank you for tuning into the deep dive.